And welcome back. In today's video, we're going to talk about Fannie Mae's latest housing market forecast through 2026 regarding mortgage rates, home prices, and much, much more. What I found to be really interesting here is that they really downgraded their forecast for home sales in 2025 as well as 2026. I'll discuss that here in a little bit, how it compares to other companies such as Zillow and also my personal forecast as well. Anyways, according to them, it says higher mortgage rates likely to keep existing home sales near multi-decade lows. If you guys follow the channel, if you guys read the news, in 2024, we had a 29-year low of existing home sales. In other words, excluding brand new home construction. It says the recent jump in the 10-year treasury yield and the resulting rise in mortgage rates are expected to continue to weigh on existing home sales in the near future, likely keeping them at or near their lowest level since 1995. They also go on to say the following. They have this updated expectation for fewer additional rate cuts over the coming years in response to incoming economic and other data. They're talking about the federal funds rate, which is the rate that the Fed controls, which is the overnight rate that banks charge each other to lend money toward each other. It does not correlate directly to the fluctuations in mortgage rates, but overall, they are loosely connected. So in any case, here's what the Fed is actually looking at, though. A, the labor market in the United States is doing well, and B, inflation is still well above their target range. Therefore, the Fed is not inclined to reduce interest rates anytime soon. And on top of that, if they were to cut interest rates, that could cause inflation to rise further. So we'll have a look at the CME Fed Watch tool, which provides kind of like the street's forecast regarding the federal funds rate over the next couple of years. And something that's really a big change, I actually just saw this, they're only forecasting for 1 or 2 rate cuts this year, which is way different compared to the fall months last year. Several months ago, the street's forecast was calling for 4 rate cuts in 2025. Now we may potentially only get 1 or 2. And that's this right here. The federal funds rate is at 4.5%. The next meeting by the Fed is on March 19th this year. And by 86.5% probability, the Fed is going to pause rates once again. Last week, they also paused rates as well. Now, fast forward through June 18th. That's actually the first meeting that potentially we could see a rate cut by 25 basis points. That's at about a 44.8% probability as of today, which is on February 3rd. Then to end the year, their last meeting is scheduled for December 10th. It's basically kind of split between, we're going to be at 4% to 4.25%. So in other words, big picture, the street's forecast is only for 1 to 2 rate cuts this year. And of course, 2 rate cuts would be 4%. And of course, only 1 rate cut, we'd be at 4.25% by year end. And this is causing overall an indirect relationship to a higher mortgage rate environment, which is likely to keep home sales very low in the near term. And because of this, according to Fannie Mae, it says as a result, both affordability challenges and this lock-in effect will persist, hindering home sales. Now, speaking of this lack of housing affordability, I talk about this on the channel for, indefinitely for years now. Here is the latest trends we have from Redfin. This is actually from the 4 weeks ended January 26. So the average mortgage payment of would-be homebuyers is just over $2,700 per month. That's the highest level since about April last year. And back in April, we had all-time record highs in average monthly housing payments. So it's fair to say that we have this housing affordability at still at very crucial levels right now. And that's keeping home sales low. What's also keeping home sales low as well is we're still seeing this lack of new supply in the market or a lack of new listings. This graph is messy to say the least, but let me just kind of break this down for you guys really quickly at a high level. This dot right there is January of 2025. The gold line is 2022. So what happened in January, there was 327,000 new listings on par with January of 22, but still higher than 2024 in brown, and way higher compared to January of 2023. In my opinion, that's kind of insignificant. What's more important here is this cluster right here. This is 2017 through 2019. Then we had approximately what? Around 400,000 new listings that hit the market that January. This January, 327,000. So we're still seeing this lack of new supply hitting the market, looking at historical trends, especially looking at pre-COVID levels. Therefore, because of this lack of new supply hitting the market, and on top of that, this housing affordability issue we have right now, this is all keeping home sales at low levels. I also did some digging for you guys regarding this lock-in effect. Based on this article I read from Realtor.com, approximately 83% of homeowners who do have a mortgage on their house have a rate below 6%. This lock-in effect is keeping inventory levels at bay somewhat, kind of putting downward pressure on inventory. But overall, we still have more inventory compared to 1 year ago, even though for the nation as a whole, we have a lack of houses for sale compared to 2019. Here's a image looking at inventory compared to 2019. And as you guys can see, it varies quite a bit. Areas in orange, or I should say states in orange or red, have more inventory compared to Q4 of 2019. So for example, Arizona is up by 16%, same for Texas, 14% gains in Florida, and also a 16% increase in Tennessee. We're also having more inventory compared to 2019 in Oklahoma, Colorado, Utah, Idaho, and Washington, for example. In contrast, in California, we're down by 16%. Also, same goes for Nevada as well. But we have a lack of house for sale in much of the Midwest as well as the Northeast. And go figure, we have a big increase in home prices over the past 12 months in the Midwest and the Northeast, but also in California as well. Okay, let's get back to Fannie Mae's predictions here. And here's a high-level overview. We'll talk about sales, then we'll talk about home prices, and then mortgage rates. So for new single-family houses, their forecast is calling for a 7.1% increase in sales compared to 2024, then to be, relatively flat in 2026, only up by 1%. For existing home sales, quite a bit different, a small gain up by 2.3% this year, and a big increase up by 8.4% in 2026. Therefore, next year they're predicting 4.5 million sales, and this year at 4.15 million. Now here's the analysis I did based on historical trends looking at data from the National Association of Realtors. So Fannie Mae is now predicting for, again, 4.15 million sales this year of existing houses. That'd be a small increase up by 2.2% compared to 24, but still down greatly from pre-COVID, down by about 22%. My biggest takeaway regarding this is that I've been making this video for years now. I've been doing this every month. So what I noticed in their forecast at 4.15 million, this is a big downward revision compared to last month, but also from several months ago as well. So in fact, this was revised downwards from the previous forecast by 100,000 sales. Last month, they were calling for 4.25 million sales, but now it's only at 4.15 million. Also, like I mentioned a few months ago, their forecast was at 4.5 million this year. So they are much less bullish now, primarily due to a higher mortgage rate environment. Overall, this means that transactions in the United States would be around a 3-decade low for 3 years in a row. However, this does not mean that home prices are going to crater. In fact, they are predicting just the opposite. We'll talk about that here in a little bit. Let's also have a look at their forecast in 2026. By the way, that would be an 8.4% increase from 25, but still down greatly from pre-COVID levels. So at 4.5 million, last month, for example, they're calling for 4.7 million. Therefore, they revised downward their forecast by 200,000 transactions. Also, technically, 4.5 million sales would be the highest levels since 2022, but still around 500,000 fewer than what is considered normal. So for example, based on my nerdy Excel formula, The median number of home sales nationwide since the year of 1989 is just under 5 million sales. If you guys are curious, my forecast for home sales in 2025 is actually 4.2 million, and Zillow's forecast is calling for 4.16 million. Kind of in line with what Fannie Mae is predicting at just under 4.2 million. If you guys are looking to buy a house in 2025, here's my advice for you guys. I'm talking about national trends. So you may see in your neck of the woods where you want to buy. Maybe it's a very competitive market, or maybe it's just the opposite. Maybe there's a huge amount of houses for sale. So my advice for you guys is to really learn your marketplace, because national trends is likely much different than what you're seeing in your neck of the woods. Let me just kind of give you an example. Boots on the ground here in Sacramento. You guys all know I'm an agent here servicing the greater Sacramento area. And of course, my team and I service Sacramento really like El Dorado Hills, just east of Sacramento, all the way until the San Francisco Bay Area. So I just listed a home for sale about 3 days ago. It was on the market for only 2 days. We received 2 offers in a matter of 2 days, and my seller accepted an offer from a home buyer. So in 2 days, the house sold, even though average mortgage rate's around 7% right now. I also have another home buyer, actually a couple home buyers right now who are looking for houses. And every time they send me a listing, the house is sold very, very quickly. I've seen houses getting 7 to 15 offers in Sacramento, but that is kind of like an outlier though. We are getting around 2 offers per house or per closed transaction right now, either a pending home sale or a closed home sale. So it's I would say a lukewarm housing market, but it's not nearly as hot as it was when we had 3% mortgage rates. So again, going back to my advice for you guys, learn your market, what's happening. Obviously, the stats you see are going to vary quite a bit compared to the national averages. Okay, moving on. Let's talk about their forecast for home prices based on their HPI, which is their home price index. So in 2024, we should have ended the year up by about 5.8% compared to 2023. Their forecast this year is for home prices to rise by 3.5%. Then next year, a small increase up by 1.7%. So this year we could be a little bit less than half the gains we saw in 24, but in 2026, relatively low levels, but still prices increasing. In regards to the forecast for mortgage rates, here's the forecast over the next couple of years. So this year to end the year at 6.6%, then next year to be at 6.4%. That's the average for the entire year. Now here's a look at 25. We're basically right around 6.5% all year as our forecast. And then in 26 to be just under 6.5%. The interesting thing about this higher for longer rate environment is that this is keeping home sellers from listing their house for sale, but also keeping home buyers buying houses as well. But despite that, home prices are still increasing. I mean, look at this. Prices rose by 5.8% last year, even though last year the average rate was at 6.8%. It just goes to show how a housing market is quite resilient, to say the least. So that's my video for today. I hope you guys got a lot of value out of today. And of course, if you guys want a real estate agent referral, then please check out my website, which is realestateteamfinder.com. With that said, I appreciate you guys so much for watching today's video. Have an amazing day. We'll see you in the next video.